For our next panel, we're taking a bit of a step back and we're looking at global asset allocation in a bifurcated world. And I was just speaking to Ellecia outside before, who will be moderating the panel, on the actual difficulty of even deciding what that bifurcation looks like, right? Because the world is actually very multifaceted and it's hard to just split things into two. So to welcome the next panel to the stage, I'd like to introduce the moderator and her esteemed panelists. Please welcome Ellecia Saffron. She's the founder and managing director at Maysaffron. Please welcome Ellecia and her panelists to the stage.
Thank you, Rachel, and good afternoon, everyone. As Rachel said, interpreting this topic today can be done several ways. The bifurcation of this market can either be East versus West, or the US versus China. Or as Mohamed El-Erian said last night in his address, we've had the greatest quantitative easing of all time, yet that hasn't trickled down into every part of the economy. And so this afternoon, we're very lucky to have with us today 4 leaders in the investment world. They collectively have over 90 years of investment experience and manage more than $80 billion of assets under management. I'd like to get them to introduce themselves first. We'll start with you, Rob.
Sure. Rob Shafir, CEO of Sculptor Capital.
Hi, I'm William Ma, CIO of Noah Holdings and Gopher Asset Management.
Troy Gayeski, co-CIO of SkyBridge Capital.
Faisal, Sarkhou, CEO of KAMCO Investment Company.
So today we're going to cover the 30,000-foot view of these gentlemen and their firms and what they think of the global economy and the outlook, and more importantly, how they are applying that in the strategies that they're doing and what their clients are seeing and doing. We're going to start with you, Troy. So in the last week alone, we've had Gopher and Goldman Sachs come out with their outlooks for next year, both with some bullish outlooks for growth in the US in particular, and we've heard about that in this conference so far. However, Goldman's did say that 90% of their PE clients were preparing for a recession. Mm-hmm. What is your view, and what is the SkyBridge view?
Yeah, so let's take some of those forecasts with a grain of salt, because some of these same people were calling for imminent recession not so long ago, right? But yeah, look, I mean, right now, we think the risk of recession is modulated to some extent. We were roughly 1 in 3, about 6 weeks ago. For a variety of reasons, we're now down to 1 in 4. When you look forward, the bad news is that CapEx is declining. Some expect a bounce back of that next year. Fortunately, the consumer's in very good shape. We're still getting hurt on the trade channel, of course, which doesn't look like it's going to improve anytime soon unless the dollar weakens. But the bottom line is the risk of recession is 1 in 4. Most likely outcome is somewhere between 1.5% to 2% growth, which would be a marked deceleration from this year. But unlike the perma bears, 1.5% to 2% growth, we still think is a healthy growth rate. And we think the challenge for investors in an environment like this, where equity multiples are as high as they are, roughly 17.7 times in the U.S., and interest rates are obviously extremely low globally, is how do you generate that mid to high single-digit return without exposing yourself to undue risk, right? And so when you think about bifurcations of asset classes or bifurcations of the globe, one of the greatest bifurcations we see currently in the U.S., which is our primary focus right now for a variety of reasons, is the bifurcation between consumer credit, where you see exceptionally strong metrics that continue to improve, versus corporate credit, where you continue to see deterioration. So, for instance, if you look at the consumer, you've had debt to GDP drop from about 100% to 75%. Debt to income's gone from 1.36 to 0.98. You look at savings rates are very healthy, and financial obligation ratios are at 39, 40-year data series lows. And in contrast, if you look at corporate credit, corporate net debt to EBITDA has gone from about 1.45 pre-crisis, it's all the way up to 1.8. If you look at debt to GDP, it's just about to crisscross the consumer. We're up to 75%, which is the highest it's been in over 40 years. And obviously, underwriting standards and covenants in corporate credit have deteriorated dramatically. So that's the major bifurcation we've focused our investment ideas on today, and we'll talk about those in a bit.
Great, and we will come back to you to go into those in a bit more detail. Pivoting east for a moment, we've also got great expectations of a US-China trade deal occurring possibly in the next week. What are your views coming out of China in the context of that, William? And where are you seeing the opportunities when you look at the state of the world from the China and Hong Kong angle?
I really like the topic of bifurcation. You know, we talk a lot about China today, and I'm going to share more on bifurcation on the micro level. What happened, the trade war has done to China actually is creating a lot of companies that is growing very fast. So bifurcation number one is no matter the trade deal will be agreed or not, a lot of companies and sectors, they were growing at very fast level. For instance, you know, if we look at consumption staples, next year, you know, earnings, we are talking about 8% for the world. But the China consumer staple sector earnings is growing at 3 times, 24%. Consumer discretionary, the world, you know, we are talking about 12%, you know, earnings growth next year. But in China, for the consumer discretionary, we are talking about 24 times. So bifurcation in a sense that despite the China GDP is slowing down to 6 or 5%, but a lot of sectors is actually growing at a very fast pace. So this is the micro bifurcation level number one. And then the number two bifurcation is, you know, early on we talk about active versus passive manager. Actually, in China, it's a paradise for the active manager. For example, we are seeing a lot of industry diversification, meaning that the sectors are so fragmented. You know, Gopher being the largest asset manager in China, we are managing 26 billion US dollar. But we are only 1.3% of the whole trillion, you know, AUM market cap for the whole alternative investment space. So a lot of sector like this actually is very good for active stock picker, stock manager to outperform the market. Last but not least, bifurcation in terms of sector exposure. In China, year to date, the best sector is up about 80%. The worst sector is down 5%. We're talking about 85% dispersion, if you like. But in the US market, we are talking about 40%. So all in all, I think there are bifurcation in terms of slowing down China growth, but sector can grow very fast. Bifurcation in the investment world in which active manager still are early stage investment, you know, in the China market.
Excellent. Allocating assets in a transition economy. Staying east, Faisal, and looking at MENA, what are your thoughts in this context, and particularly when listening to William, and how do you see the state of the MENA world and in the bifurcated state, and where the opportunities might be?
I think you need to look at the context of the region. So if you talk about MENA, if you look at the entire population of MENA and combine them as a single group, you're talking about the 4th largest population group in the world. If you look at it from an economic side, a growth or a real GDP growth prospect, estimated real GDP growth is at 2.9%, which this is over the period until 2024. Putting it as the 3rd highest after India and China. Taking that, I mean, even looking at the demographics, you have a youthful population, you have strong fundamentals for growth. Looking at the GCC more in particular, you have one of the highest income per capita brackets in the world. You have a lot of sovereign wealth funds that have been established many years ago that have been seasoned in investing regionally, internationally. You have a start of the private sector, strengthening of the private sector, which has been there for many years. And if you look at the current state and what's going on, if you want to look at a bifurcation model, you could say that there is this shift from the old economic and to a certain extent political system to a new one. So if you look at the drive by governments to diversify away from the oil sector, in the GCC in particular, you look at what's happened in the recent period, the IPO of Aramco, the largest company today in the world. We had 2 IPOs in Kuwait where our headquarters are, Kuwait Stock Exchange, which is also privatization. So the stock exchange was owned 100% by the government. As we're speaking, we're doing the allocation for the public. It's now 94% owned by the private sector. The same thing happened in the utilities sector as well in Kuwait with another company. And I think whether it's Kuwait or any other GCC company, Saudi, UAE, the rest of the region is focusing on getting into this new model of privatization, and it's part of the reform that has happened at regulatory levels, at all levels, and you can see the results of that happening with countries going from frontier market in the capital markets to emerging market status. So if you look at this month, Kuwait is expected to be in the MSCI emerging market standard, pushing the allocation in the emerging market of the GCC to around 5%. That's going to have an impact. We've seen it in Kuwait, so we've had some of the best market performances in the past, during this year to date has been a great year for equity managers. Coming to the debt side, I think that's the side that needs to develop more. We still are lagging a little bit there in terms of structured debt. And looking forward, I think the economic factors are positive. With more political stability regionally, internationally, I think we're optimistic, cautiously optimistic.
Great. Now, pivoting a little bit more and looking more bottom-up, Rob, at Sculptor, you're bottom-up stock pickers or opportunity exploiters, essentially. Where are you seeing the greatest opportunities at the moment, particularly in sort of the global context that's just been discussed?
Sure. Well, it's interesting when you mentioned before, where the big strategists are. I mean, there's not a lot of dispersion amongst the different firms in their outlooks on the economy and markets and so forth. And if you think about it, you've had obviously huge central bank intervention. You've got very low rates. You've got what appears to be an economy, a global economy that feels like it's stabilizing, and you may see some kind of an upturn there. But as Troy mentioned, you've got asset prices that reflect that. You've got obviously very tight spreads in the debt markets. You've got multiples, that are reflecting, fairly high prices, just given the amount of liquidity in the system right now. We're not a sort of tops-down investor. We obviously consider that as we think about investing. We're much more bottoms-up, and I think what we find advantageous is just the ability to be completely unconstrained, meaning we can invest in any geography, in any asset class across those geographies. And I think the key part is to be nimble. And the reason why I think that's so important is, if you really think about it, we've had 10 plus years of, with some exceptions, sort of one-directional markets, massive, low rates, low vol, significant asset inflation over the course of that period of time. But I ask a lot of allocators when I meet with them, I said, okay, well, that was the last 10 years. How do you think about the next 5? Do you think it's going to stay that way, or might it be different? And I would submit to you that there's a reasonable chance that it might be. It seems to me that there are a lot of unanswered questions and potentially clouds out there. So I think the ability to be nimble is going to be critical to investment performance, both from the opportunistic side as well as the defensive side. So I mean, simple examples. If you look at the United States, and this is not a political statement at all, but Donald Trump, Elizabeth Warren. So if you're sitting in the healthcare space and you're a company in that space, the implications of one of those two candidates winning are diametrically opposite, whether we're going to have universal healthcare and no private options, or something that is similar to today. So for example, when Elizabeth Warren went up significantly in the polls earlier in the year, the healthcare stocks crashed. So we took advantage of that, and we were active in buyers of that, and subsequently you've seen some of Warren's numbers come down as people have really tried to scrutinize her plan and the affordability of it, and I think she has gone down to the polls. As she has gone down to the polls, guess what? Those stocks have gone up. So I think it's an example of just trying to look for the opportunities in there, whether it's things like that, or whether other situations where there's just a real void of capital. An example of that would be the energy sector. That's been the most bombed out sector, globally for quite some time, and there have been some real false starts there. But as we start to see the loan markets become a little bit more unglued here, you're seeing this bifurcation between the high quality credits, which essentially have a firm bid, and the lower quality, more challenged, companies and sectors, which are really starting to widen further and further. At some point, and we're starting to look at the energy sector as a place where there's some opportunity within that carnage. So I just think, having a very broad lens and the ability to be nimble to take advantage of that, or conversely flip it around and go the other way when you start to see those clouds come a lot closer, is how we're thinking about things.
Great, thanks, Rob. Troy, can you go into a bit more specific detail on the trade ideas or examples?
Yeah, sure. So if you think about different ways to play consumer credit, in general, we like assets that have tangible assets behind them, or securities with tangible assets behind them, because you have some idea of what that is, whether it's inflating in value or not, what recovery rates will be in the event of a default. And what's interesting now is you have this strong economy, strong labor market, also very reasonably robust housing market and commercial real estate markets that have only been further helped by what are now interest rates far below what I think any master strategist expected 12 months ago. And so, within RMBS, there's really three areas. You can still play legacy, you can play the new issue agency CRT market, and you can also play the new non-QM equity residual. So, there's certain sectors that don't qualify under the Fannie, Freddie, or Ginnie umbrellas that then are starting to get packaged into non-qualified mortgages, and you can issue those and retain the equity resids. And all three of those strategies generally, kick out 6, 8, 10% type total returns over time. We like that a lot. One of our fan favorites right now, though, which we like even better, is a market called the Freddie small balance loan market in commercial real estate. So this is a niche sector that's really laser focused on workforce housing. And if you look at the U.S. Commercial real estate market, and particularly multifamily, what you'd see is the only area of excess is really in luxury or ultra luxury. And as you move down the area median income and you get to workforce, which is defined as somewhere between 60 and 100% of area median income, what you see is about a 1.5 million unit shortfall nationwide. Because there's no builder that gets out of bed in the morning and says, I'm going to go build me some workforce housing. Right? Workforce housing is depreciated, typically B properties that were built in the 80s or mid-90s. So you have very favorable supply-demand dynamics. Coupled with that, as you're probably aware, due to a tight labor market, the bottom decile of wage earners and the second quintile of income has had the most growth the last several years. And so you have very favorable supply-demand now, and it's no surprise that you have the biggest appreciation in prices, the biggest drop in vacancies, and the biggest increase in NOIs. And so, when this market started, it was obviously $0 billion back in 2014. It was a little too illiquid for us then because, again, to Rob's point, we like to maintain liquidity so we can evolve. But as it's grown, it's about $17 billion now. And when the market started, it was the B pieces were offering about 14.5% loss-adjusted yields. Now markets are inefficient, but not that inefficient for that long. And so now yields are down to about 9.5 to 10. And we're the first to admit you're taking risk, right? This is not risk-free. There are scenarios you could lose money if you had a far worse outcome than, say, the financial crisis. But that's one of our favorite long expressions now. And then the short side, it's pretty simple. You want to short things where you can't, you have limited downside, meaning they can only go up so much. And given how tight corporate credit spreads are, we're pretty close to the absolute low in yields for both IG and high yield. Spreads could tighten further, but there seems to be a 5.5% nominal yield floor for high yield. And we're 98% certain we'll get disproportionately punished in the next recession. And so given all the misbehavior that's gone on in corporate underwriting and the leverage levels today, we feel very comfortable carrying that short book, to insulate us from, dislocations like we had in Q4 last year, or if our economic forecasts are wrong and the perma bears are right, and we actually will have a recession 100% guaranteed starting 9 months from now, we can limit our losses to 10% or less. So that's our favorite bifurcated trade setup right now.
Okay, thank you. William, can you talk about your views from a trade perspective? I saw an interview of you recently with you citing the fixed income bubble in the market and pushing banks, Chinese banks, heavily. Can you
Yeah, I think
expand on
Hong Kong is another bifurcation type of market. If you like, we have to separate fundamental versus sentiment. Actually, we are increasing our exposure in the Hong Kong market. For example, 95% of the market cap in Hong Kong, their revenue is outside Hong Kong. But the market got sold down dramatically. So, key theme number one is the banks, Chinese banks trading on the Hong Kong Stock Exchange. They're traded at 5 years low in terms of valuation, 0.8 times price to book, but 6 to 7% dividend yield. We believe this is a good substitute for a credit bubble, if you like, moving to equities. And then the second thing we are excited is about the high-end manufacturing sectors in China, in which, as I mentioned earlier, because of trade war, a lot of the companies, they are sourcing components internally. Those earnings growth are very fast. We are talking about 40% plus. Last but not least, we are very excited in the consumption upgrade in the China market. For example, food and beverages. Guess the largest soy sauce manufacturer in China, they have about 18% market share. In Japan, about 33%. And average people in China, try guess how many kg of soy sauce they consume every year.
I'm going with 12.
One.
One, okay. Yeah.
But in Japan, it's
What do I know, right?
But in Japan, it's 6 kg, per year. Meaning that when people get richer, they buy branded soy sauce and then they consume more. I think this part has nothing to do with the trade war. So this is a bifurcation, for active manager, if you like. But 12 is a good guess, being a chemical background.
It's only off by a factor of 12. Yeah.
buy soy sauce. And Faisal, what are your clients doing in MENA, and where's the sort of interest in allocation? Is money flowing out of the region, or where within the region do you think is the best trade ideas?
Well, just to explain, as KAMCO investment company, we manage around $14 billion of client money, assets under management. We're about number 5 in the region in terms of size. We have 3 core markets with an additional 4 also under consideration. So headquartered in Kuwait, full-fledged activity in Saudi Arabia, and in the DIFC in the UAE, in addition to Egypt, which is we see as a large market that we have to be in. Now, our clients and our investments are in the region primarily. We can say maybe from the $14 billion, we have around 10-15% that is out of the region. The out of the region piece has grown in the past 4 or 5 years, where we've grown our real estate, international real estate portfolio in the US and Europe. What we see clients seeking, we've had a period post-financial crisis where there was loss of trust and faith in investing to a certain extent. During this 10, 11-year period, we've seen more institutionalization, a lot of reform, a lot of changes to regulation, regulatory bodies coming out, and that has helped a lot in what I referred to earlier, moving the equity markets or the capital markets from frontier to emerging. And in general, what you see with the regional investors is still they like, they want maintainable kind of returns. So they want to be able to generate returns that are year on year, not too volatile. They want dividends as well. Cash flow is a key component of what our investor base is looking at. And of course, like any investor, they don't want to lose their money and they want to grow.
All reward, no risk. How about that, right?
So we see outflows going out. Interestingly enough, with this emerging market status coming into the region, we're seeing more foreign direct investment coming in into the capital markets. And I think as more investments come into those regional or our regional markets, they'll be more interested in looking at other opportunities. Coming back to the fact that there's significant growth opportunities in the region. But our client base really is for us, we've just completed a merger with another company. We're about to relook at new opportunities. We see the infrastructure space in the region as interesting, the private credit space as well as interesting, trade finance as well in that space. Real estate remains solid. I think regional real estate will become a theme in the future once there's more unification of regulations relating to that. You know, if you look at the region, still the mortgage finance space is not developed, so you still have a lot of scope for growth. Plus the dynamics of the region, that the bulk of the business is run through government initiatives, and I think privatizations will help also enhance that. So I think, you know, our client base, I did mention on the investment banking side, we've seen a lot of activity. We've had a light period of IPOs and the like, but we're seeing that resurging back again as markets prosper.
Okay, thank you. Now we're just going to do one quick thing to finish. I'm going to ask you to choose buying on a 2-year view. We've got the greatest valuation spread in the forward equity indexes for developed markets versus emerging markets that we've had in a while. What are you picking on a 2-year view, EM or DM? I'm going to ask each of you to choose one.
Again, not generally the way we do things, but I would
Just
say,
for fun.
yeah. I mean, I think I would venture to guess EM.
EM.
I just think the value, I think if you listen to Mohammed Aaron earlier this morning, he talked about just the amazing growth of the developed markets in the last 5 or 10 years versus the emerging markets, and at some point you would imagine, by definition, the global economies either recover and you start to see that bid in the emerging markets, or conversely, the developed markets will likely come down. Sorry.
Thank you. One word.
EM, long China, and we'll be your reliable local partners.
Tell me who's going to win the election in 2020. No, but seriously, assuming Trump wins, the dollar stays strong, it's still developed markets, meaning the US of A.
I'd say a bit more EM than developed.
Okay, and then one last one. No one said the word in this panel, which I found funny, but tech versus commodities. Same question on a 2-year view.
We're still, secular bulls on tech.
Commodity.
Tech.
Tech.
Awesome.
Oops.
Thanks, guys. Thank you very much, and thank you, everyone.